Welcome to today's video on why paying thousands per month for life insurance near retirement can devastate your savings. First, we'll frame the core problem and why it matters so much at 65 and beyond. Here's the roadmap for today. Next, we'll outline the $2,000 per month problem, then evaluate whether you still need life insurance. After that, we'll expose the investment trap of expensive permanent policies, move into a practical step-by-step plan, and show how redirecting $2,000 per month can transform your retirement. Finally, we'll check your understanding with quick quizzes. This content is for education, not individualized advice. Before changing or canceling policies, consult a qualified fiduciary professional who understands your situations. Policies may include surrender charges, tax implications, and other provisions. Always verify details with your insurer and advisor before acting. With that clarified, let's move forward. $2,000 per month equals $24,000 per year, which is a massive cash drain for many retirees or near retirees. Over 10 years, that is $240,000 with no growth if it's just paid as premiums. Alternatively, redirecting that same cash flow into savings and investments can create liquidity for emergencies and allow compounding to work for you. In contrast, premiums to insurers often route through fees and may limit access, sometimes via policy loans or penalties. Therefore, the opportunity cost is substantial. Now, let's decide whether you even need the coverage. Comparing paying premiums against investing directly, the premium route creates an ongoing outflow with limited access and various policy charges. There may also be significant agent commissions built into the structure. Historically, investment returns after policy costs can be inferior to low-cost index funds. Conversely, investing directly in liquid and low-cost accounts means better access, clearer fees, and stronger long-term growth potential. Next, let's determine whether you even need life insurance at this stage. This table shows the scale of the decision. At $2,000 per month, you are paying $24,000 per year, or $240,000 over 10 years without growth. If you instead invested $2,000 monthly at roughly 6% annual return, the future value is approximately $327,600. Assumptions are illustrative and not guarantees. Now let's rigorously assess whether you still need insurance. Start by identifying whether anyone still relies on your income. Then list your debts, including any mortgage, other loans, and expected final expenses. Next, review your assets and guaranteed income, such as pensions and Social Security, as well as survivor benefits, if applicable. If adult children are financially independent and debts are mostly paid down, the need for life insurance often drops significantly. In that case, consider reducing coverage or self-insuring. If you have a narrow, temporary gap, a small, low-cost term policy can sometimes be appropriate. With that framework, let's examine the common investment trap. Permanent policies that are pitched as investment strategies often come with high internal costs and commissions, which can slow cash value growth and reduce overall returns. The pie chart is conceptual and only illustrates how premiums can be parsed among cost of insurance, fees, commissions, and eventual cash value. Actual allocations vary by product. The main point is that mixing insurance and investing generally leads to higher costs and less control. For growth and flexibility, direct, low-cost investing in tax-advantaged or standard brokerage accounts is typically more effective. Now, let's translate these insights into a concrete action plan. Here's a practical 9-step plan. First, calculate your actual liabilities and who, if anyone, still depends on your incomes. Second, if coverage is still needed, consider a modest term policy to bridge a temporary risk. Third, avoid converting to expensive permanent coverage. Fourth, redirect the $2,000 per month into liquid accounts and diversified investments. Fifth, build an emergency fund of 3 to 12 months of expenses. Sixth, prioritize paying down high-interest debt. Seventh, maximize tax-advantaged accounts for which you are eligible. Eighth, use low-cost index funds and automate contributions. Ninth, review the plan annually with a fee-only fiduciary. Next, a decision map will help you visualize your choice. This decision map begins by asking whether you still need life insurance. It then evaluates 3 key criteria: whether dependents still rely on your income, whether you have unfunded debts or final expenses, and whether assets or survivor income are insufficient. If any of these are true, the path suggests considering small, low-cost term coverage and reviewing annually. If none are true, the map suggests reducing or dropping coverage and redirecting the $2,000 per month into savings and investments. In both cases, it highlights consulting a fee-only fiduciary for personalized guidance. Now, let's verify your understanding with a quick quiz. Question: what is the primary role of life insurance near retirement when adult children are financially independent? Options: A. To act as your main investment account. B. To replace income for dependents and cover remaining debts and final expenses. C. To maximize agent commissions. D. To guarantee stock market-like returns. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Life insurance primarily replaces income for dependents and covers remaining debts and final expenses. It is not designed to be your main investment account, nor does it guarantee stock market returns. If dependents are independent, the necessary amount of coverage usually declines. Now, let's look at how redirecting $2,000 per month can accelerate your financial stability. Automate $2,000 per month into savings and investments as soon as you are paid. Sequence your priorities. First, build an emergency fund, then aggressively reduce high-interest debt, and then invest in a diversified, low-cost portfolio using broad market index funds. Rebalance periodically and keep expenses minimal. Maintain adequate liquidity for emergencies and planned expenses. Using a 6% annual return assumption, $2,000 monthly for 10 years can grow to roughly $327,600, though actual returns will vary. Next, a second quick quiz to reinforce the key takeaway. Question: if your policy is expensive and your retirement savings are thin, what is usually the best move? Options: A. Convert to a more expensive permanent policy for investment growth. B. Keep paying $2,000 per month forever. C. Immediately redirect that $2,000 per month into liquid savings and standard investments. D. Stop saving altogether. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Redirecting the $2,000 per month into liquid savings and standard investments generally improves liquidity, reduces fees, and supports better long-term growth potential. Converting to more expensive permanent coverage typically compounds costs, and doing nothing erodes your financial position. Now, let's cement the major takeaways. The key takeaways are straightforward. First, $2,000 per month equals $24,000 per year, which is a substantial drain. Second, insurance is meant for risk transfer, not for investing. Third, if needs are minimal, consider small-term coverage or self-insuring. Both. Redirect premiums into liquid, low-cost, diversified investments. Finally, consult a fee-only fiduciary and review the plan annually. Next, we'll wrap up and invite your participation. To conclude, assess your true needs and avoid over-insuring. Be cautious with permanent policies marketed as investments. Automate redirecting $2,000 per month into savings and diversified investments. And protect your liquidity. As we finish, we have one final message for you. Thank you for watching. If this helped you, please like the video, share it with someone planning for retirement, and subscribe for more practical, research-driven content. In the comments, tell us how you would redirect $2,000 per month toward your retirement goals.